happy to be back here at Prairie View. I guess I've been coming here, for the last 8 years. Some of the students who I talked to years ago, I'm sure they've graduated now, moving on with their lives. The last 2 years I haven't been able to come because I had a conflict in my schedule and I had other persons to come. But we always have to come here. Yesterday I was at Texas Southern University. We had great sessions over there. And I'm here today, and tomorrow morning I'll fly back to Washington, D.C. But we have been presenting financial literacy training to college students, particularly students of historically black colleges and universities over the last 12 years. And one of the reasons why we started presenting seminars, we saw that a lot of students were dropping out along the way, or if they graduated, they weren't able to manage the financial resources that were being generated from their degrees. So we thought we would give you those life skills, that financial information that you need to get the most out of your degree. So we present credit management seminars, personal money management seminars, and investment education seminars. Today we're going to talk about investor education. And one of the reasons why I want to talk to you about investor education is that we see that the median net worth, particularly of African Americans, is very low, like $5,700. We also see that more and more companies now are moving away from defined benefit plans. For all college graduates now, your chances of getting a job with a corporation that will pay you a pension at the end of 20 years or 30 years is lower and lower. Your chances are lower each year. All the companies now are moving toward the 401k plans, where you have to use a portion of your income to accumulate money for your retirement. But some people don't understand how to make those decisions associated with the 401k plan. So what we're going to do today is to make sure you understand how the process works so you can accumulate money for your retirement. Because this is the first step in creating wealth for yourself, getting your degree, and use the income to sustain yourself and to create wealth for yourself. That's what you want to do. That's the whole process here. It's not about getting a degree, acquiring a job, and buying a lot of stuff. It's all about accumulating wealth for yourself. Now, another reason why you want to do this is that the latest information from the Social Security Administration that was issued last year shows that the average Social Security benefit that individuals receive, age 65 years or older, is $1,170. $1,170. Now, most people can't live off of $1,170 a year. So it's really incumbent upon all of you, or everyone, to start accumulating money for their own retirement and not rely on Social Security. Furthermore, you don't want to be subject to the whims of politicians, right? You hear the news all the time, we're going to cut Social Security, we're going to cut Social Security, or you got to wait until you're 75 years old before you receive the benefits. You want to make sure that when you get ready to retire, you can retire. Now, my goal when I finished school was to retire at age 48. Now, as I'm going to retire at age 48, I want to work hard, finish in the top 10% of my class so I get the highest salary that was being offered at the time. I did that, and I controlled my recurring expenses, saved and invest. I ended up retiring at age 52, because I had a daughter later on in life. And when she became a junior in college, I retired, So I sat around the house for a year. But I said, I want to go out and help other people too. So I set up this organization to come back to be able to help other people in terms of how to manage their financial resources so they can do well and have some options in your life. So you have wealth. It's all about building wealth, and having options in your life. So we're going to talk about building wealth, through investing. Now, just to further amplify what I was saying is that I was reading the Washington Post the other day, and it talks about it right here. It augments what I was saying. More Americans are managing their own retirement savings. It's going that way. There's a chart that shows that that's all that's being done now, but you have to make a decision. Yesterday afternoon, I was talking to a group over at Texas Southern University. One young lady was working in a human resources department at a company, and she said, look, people come in there, we got a 401k plan, they don't know what to do. They don't know what to do. They just have those listing of mutual funds there. They don't know what to choose and what not to choose. But when we finish this session today, you'll be able to make a decision on how to deal with it once you start working after you graduate from Prairie View University, So we're going to talk about that. Now, in terms of wealth. Now, wealth is created primarily through three ways. Through the acquisition of financial assets, stocks and bonds. Most people get rich investing in stocks and bonds, and through home ownership, Then you may have a few who will get rich through an inheritance, but you don't want to rely on an inheritance because you don't want to wait until someone dies before you become wealthy, right? Okay? So you got to look at learn how to invest in stocks and bonds and home ownership to generate the wealth for you. Now you say, how did the stock market get started? Well, it got started some years ago. Back in 1790, the first stock exchange was established. Okay, and then 1792, you had 24 of the New York City's leading merchants came together to create some order to the security business. And then 2 months later, they signed an official document. Then the New York Stock Exchange was formally organized on March 8, 1817. And then in the 1900s, all of a sudden, stocks started moving. The value of stock was increasing. People got afraid, said, it can't be real. I'm making all this money. So all of a sudden, they panicked. And you had the first crash to occur in October of 1929. And then we had another crash to occur in 1987 when we had the tech bubble to occur. Now, why I'm telling you this, you have to realize that even though you have these ups and downs to occur in the stock market, you want to play it for the long term. You don't become afraid. Now, some people became afraid back in 2008 and 2009 when we had the housing bubble and the economy went down. No one knew what was going to happen to the economy. We were in a downward spiral. The stock market went down to 6,000, right? But now it's over, back up around 13,000. Those people who became afraid in 2008 and 2009, they lost a lot of money. So you're going to play it for the long term. Don't be afraid. You play it for the long term, okay? Because over time, the stock market will outperform all other investments, okay? And since you're young, you have time on your side. You can deal with the ups and downs in the market and still make money, okay? Now, what are stocks? Now, stocks are equity investments. They represent ownership in a company. So if you were to invest in Coca-Cola, Dell Computer, Google, Apple, General Electric, you become part owner. You become part owner of that company. If you have 100 shares in Coca-Cola, you're a part owner of Coca-Cola. You have 100 shares in Dell Computer, you're a part owner. And so you get a chance to, as that company grows, the value of your investment grows too. Because you're part owner of that company. Now you have 2 types of stocks. You have common stocks and preferred stocks. We'll talk about common stocks first. Now, in common stocks, we have what is called blue chip stocks and growth stocks. Now, what's the difference? Now, blue chip stocks are stocks, companies that have been around 25 years or longer. 25 years or longer. Some people say, look, I'm only going to invest in blue chip stocks. I know they're going to be around, I don't be concerned about they're going out of business. So I'm looking at Procter & Gamble, General Electric, Johnson & Johnson, Coca-Cola. Companies been around for a long time. Home Depot. Those are blue chip stocks. They are stable and they pay dividends. Then you say, well, I also want to look at growth companies. Companies haven't been around for a long time, but the potential for growth is there. Okay? So you look at companies just getting started, some of the biotech companies. For instance, there's a company coming out with a product that's going to deal with diabetes. We know that diabetes is a big issue in this country. 23 million people have diabetes, right? So they think they got a drug that's going to be able to address diabetes and also obesity. The company the other day, back in February, as a matter of fact, the FDA panel said, sounds like a good drug, it's going to work. The price of the stock doubled in one day, okay? Short history, but the potential for growth is there. You look for companies like that. And there are other companies, similar companies, even on the environmental side. So you say, I'm going to invest in some of those companies too. Then you have preferred stocks. Now, preferred stocks are more a hybrid, where you have a common stock, but it also has the first rights to enter dividends that are being paid by the company. So the company like GE pays dividends every quarter, but they must pay the preferred stockholders any dividends. That's income in excess of their profits that they distribute to the stockholders, must go to the preferred stockholders first, then they go to the common stockholders, okay? Now you say, why do you invest in stock? You invest in stock for the long term, it's not a situation where you're going to buy today and sell tomorrow. Or you can have a situation, however, where you make quite a bit of money on the stock. For instance, where everybody thought that the auto industry was going by the wayside, right? GM filed bankruptcy, Chrysler filed bankruptcy. All of them borrowed money from the federal government, okay? But Ford Motor Company didn't borrow any money from the federal government, okay, at all. But the stock went down to a $1 a share. Went down to $1 a share, okay? So it came back. It went up to $19 a share. So you say, well, I made $18,000 on the stock. I only made a $1,000 investment. I bought 1,000 shares for $1,000. I'm going to take the $18,000, and that's good for me. I can use it to make other investments. If you have a situation like that where you think you realize all the gain that you want to realize from the particular investment, you can take it. You don't have to play it for the long term, okay? Now it's back to $12 a share, but if you borrowed $1,000 a share, you're still up $11,000. You see what I mean? And that capital appreciation means is the difference between what you paid for the stock, say $1,000, and the value of it now, okay? That's your wealth. That's $11,000 in wealth, okay? If you want to sell the stock, it's an increase of $11,000 in your wealth. And you buy for dividend income. You have companies like General Electric again, where they pay dividends every month. The price of the stock increases, but you also get dividend payments too, okay, by owning that stock, okay? Then you have when should stocks be used? As I said, for the long term to accumulate money for your retirement, okay? We want to look at this for the long term because at all times you want to plan your life for the long term and not for the short term, because you feel young now, as I did when I sat in the seat you were sitting in, but you later on in life you want to sit down, you want to make sure you have sufficient money, okay? And you use stocks, make investments for your child's education too. And you want to make sure your investment is definitely generating a return of 3%, so you're ahead of inflation. That's why you make investments too, okay, in stocks. Now, what are bonds? As I said before, people invest in bonds. Now, bonds are IOUs. They are promises to pay. People invest in bonds and make a lot of money off of bonds. They get the dividend income off of bonds, okay? Now, corporations use bonds, okay, to get started, as they use stocks to get started. The federal government uses bonds to finance government operations, schools and roads and other operations. Municipalities and states like the state of Texas issue bonds to finance roads and schools, and other entities too. They're IOUs, okay? And you have the promise to pay a fixed rate of interest for a fixed period of time, okay, to you as long as you're holding those bonds. Now, one way to make it clear to you is that we're going to create 4 companies. We're going to create 4 companies, and this is basically what companies do to raise all the money to get started. Nobody has a check to just write to various suppliers and employees to start their businesses. They go into the private market to raise money by selling stocks to individuals like yourself, and to and sell bonds to raise the money to get started.